Ian, what's up? So everybody just comment, just say anything. So I know you're here, so I can put you in a raffle. You can just say hi or just put the letter A if you don't feel comfortable commenting, or even a blank space. And then whoever gets picked twice gets a free DCF. So I'll do the DCF live. Usually takes like 5 to 7 minutes. Savvy Money Show. Glad I'm back. I definitely missed the channel for a while. I was thinking about like how much I missed the interaction with everybody. Yeah, work just sucks. You know, it's I don't think it's healthy to work 40, 50 hours a week. Amherst. I lived in Amherst. Well, in New York, which is Buffalo. Call the Enbridge CEO and have him or her pay their damn debt. Yeah. I'm not sure if I can get through to them, but I hear you. Lots of debt. Let me see if I can pronounce that. Isvan. Is it Isvan? Is it like a silent T? Maybe Istvan. Zolciak. That's European, right? Is that like Polish? They should have cut their dividend. Yeah, it's like a balancing act. Should they cut their dividend to pay down debt? Should they raise their dividend? Oh, Istvan, got it. It's always like it's a balancing act. It really is like having the right amount of debt, the right amount of equity and cash flow. It's really challenging. And even if you do it right, even if you make good decisions, sometimes things don't go correctly, don't go the way you plan. Or even if you do things in the best interest of the investors, people complain. So it's like you can't win. It's like do you invest in a mirage of ETFs? I invest in ETFs. I like ETFs. It's pretty safe and stable. I don't know. Like I invest in individual companies sometimes, and then I look back and I'm like, should I have just invested in like an index? I probably would have done better. Then there's times when I do well investing in individual stock, but I don't even know. Transylvania. You don't hear that every day. Transylvania. Why are you spelling it like that? Isn't there a Y in Transylvania? Or is it like, or do you spell with an I in Romania? 2 streams in 2 days. Chris. Vlad the Impaler. Yeah, I did a long stream yesterday. Has everybody been following the banking situation? Mainly Silicon Valley Bank, which is the big one, obviously. and Signature defaulted the same week. And First Republic is on the brink of default. Yeah, every time something like significant happens, like a big default like Silicon Valley, I try to understand why. And you learn a lot. I mean, because you can't really, if you listen to the news, it's very surface level. They don't really give you like the nitty gritty. And if you do get the real details, sometimes it's hard to really grasp it all just by listening. So you have to do a little digging. So yeah, I wouldn't have thought that buying these long dated assets, because they bought a lot of like 10 plus year mortgage bonds from the government, from the Fed. So kind of pretty safe stuff, not much risk there. I wouldn't have thought that's a risky kind of thing to do. But apparently when you have short-term debt, because the money that's deposited into the bank, when you put money into a checking savings account, that's debt to the bank. That's a liability on the bank's part. So, and that's short-term debt, because that money can be taken out at any point, right? You can go to the bank at any point. So when you fund short-term debt with long-term investments, that's a recipe for disaster. And that's what they do. Long-term investments. So they had like 80 billion of 10 plus year maturity assets. It's called held to maturity on a balance sheet. And that funded I think they had like 170 billion of deposits at the bank. So about half the deposits were funded by these 10-year bonds, which is not usually a problem unless, of course, interest rates go up a lot, which they did, and then they had to sell the bonds at a loss, and that led to the bank run. Clemen. Is that another European name? Bonds with 1-2% interest with money they didn't insure the deposits. Kyle, what's up, buddy? Kyle, you're Dutch, right? You're from Netherlands? If you're not from the Netherlands, somebody else with a K from the Netherlands. But Slovenia, interesting. What's up, Spencer? Tyler, thank you. I like meeting people from other countries because it helps me remember those countries if I talk to somebody or have some frame of reference. Canada, it's the other K. Well, who's the other K? I can't remember. Somebody with a K also. But anyways, okay, let's Tyler. Whoever gets picked twice gets to pick any ticker they want, and I'll do a DCF live. CM101. Let me know if your name is not on here. Yeah, try to be shy. You don't have to say anything significant. You could just say a word just so I know you're here, so I could put you on a raffle. Chris. And the first DCF I did, I was a little rusty. I forgot some words. But then the second one I did, I was kind of back to where I was. Maxiano. Sean Taylor. That sounds like a baseball player's name. 12, Maxiano. And if you want to donate $5 or more, and I'll do a DCF for whatever you want. Clemen. Tyler. So Tyler, if there's like a any ticker you want, just let me know, and I'll do a live DCF. And generally, it's pretty simple for me to do a DCF. I have it all set up. Of course, if I was doing a real DCF, I'd have more time to read through their financials, because sometimes just looking at the numbers doesn't give you the entire picture. You have to understand the numbers a little deeper. So Tyler, just throw out a ticker, any ticker you want, and we'll do a DCF. So yeah, so Silicon Valley, they funded short-term debt. This is short-term debt, the deposits with long-term assets. And someone commented earlier, Google, that's a good one, that they didn't hedge against that, which is, I didn't think of that, and that's a really good comment. They didn't hedge against the assets they have, which totally makes sense. I didn't, and other banks were hedging against their investments, because they're investing in these treasury securities that paid really low interest rates, 1-2%. So if interest rates went up to like 4 or 5%, the value of those assets goes down. So you're going to lose money if you sell those assets. And like people like me and you, we wouldn't sell it at a loss unless we needed the money, which is what happened with the bank. They needed the money, so they had to sell at a loss. Even though if you held those to maturity, you're pretty much guaranteed to get your money back because they're backed by the government. So there's not much of risk there. It's not like buying a stock where there's a lot of risk buying a stock. Okay, let's see if I can remember how to do this, the live DCF. I might be a little rusty on this too. Let's get their cost of capital. This is pretty much 90% of what I do is pretty much going to be here. There's a little more involved, but a great majority of it is pretty straightforward. Let's just put the middle one in, whack. Let's get the market cap. Yeah, if the bank run never happened, yeah. If you watch my Silicon Valley video, every bank can go bankrupt because banks hold at like 10% in cash of their deposits. So if a bank has $100 billion of deposits from people in their account, in their bank, they may hold only 10 billion and the rest they lend out. So if even 20% of the people go to the bank, want their money out, the bank doesn't have the money. And then what happens when the bank doesn't have the money? Other people hear, what? The bank doesn't have money? I want to get my money out. And everybody goes to the bank, and then the bank goes out of business, which happened a lot in the Great Depression. Every bank could go bankrupt. Even JP Morgan, which is pretty unlikely, but it could. If you ask somebody, why did Silicon Valley go bankrupt? Someone may say to you, because there was a bank run and too many people wanted to take their money out of the bank. That's why they went bankrupt. But that's like the last stage of the process. Like that's the same thing as saying, why did this company down the block, why did they go out of business? Because they ran out of cash, which is the reason every business goes out of business, lack of cash. But the reason there was a bank run wasn't just because, well, the end result was people want to take their money out. More people want to take their money out than the bank had. But what led up to that? Was they were too leveraged, so they had to sell these assets at a loss, a $2 billion loss, and then they announced they were going to dilute shareholders another $2 billion to make up for that loss, and that spooked people. Those two things spooked people. Now let's get the future revenue estimates. So the future 2025 revenue, $372 billion. $2024, 335. And after we put the basic numbers in, then we can play around with it. See how well the model works? Because when you pick a company like Google, it's much easier to predict the future because the past is so stable and they have a history. But if you pick a startup company, it's kind of a guessing game. So just based off the base case, using the middle WACC, because obviously the higher the WACC, the lower the valuation. Because if we put 9.8, watch this 128, it's going to go up to like 133 or something. Look at that, 133. Do I know these models? And if we put 10.8, it's going to go to like 122. I don't know. 122. I didn't set this up, I swear. That's amazing. Let's just pick the middle. So some people ask, how do I get the future revenue estimates? How do I get the future? I mean, it's pretty simple. I just use Simply Wall Street, and there's 19 analysts that projected the revenue for Google. And the way these analysts project the revenue from Google is from Google themselves. Google gives forecasts, maybe not 2025 forecasts. They might, but definitely at least 1 year forecast, and you can extrapolate. So these are the forecasts based off of what Google provided, also what Google historically has. That's the future revenue forecasts I just put into the model. This is 2023, 2024, 2025. You know, it was a typo. I put it. I added a number for 2023 revenue. So this is correct. The calculated stock price for Google is $84. So, anyways, so the future revenue, I just get it from analyst estimates. You can calculate it yourself. You can take the past few years and grow it at a similar rate. Whatever you think is appropriate, but it makes sense to me. 2022 revenue is $282 billion. That was actual, and this is the forecast. And then the way I calculate the free cash flow, the model does all this, but it looks at the revenue the past 4 years of revenue, the past 4 years of free cash flow, and then on average of those 4 years, what percent of their revenue they converted to free cash flow. Because we have the future revenue, right? So we need to know. So in the past, what percent? So it looks like about 22%. So on average, they convert 22% of their revenue to free cash flow. So I just multiplied these future revenue estimates by 22%. And that's how I got the future free cash flows. And then terminal value is just another formula. You can just Google terminal value. I can email you the calculation, but I mentioned it a lot on it just looks at the last year free cash flow. This is just a defined term, terminal value. It just looks at the prior free cash flow, and our estimate was 93 billion. And then you multiply it by your growth rate. I did 2.5%, my growth rate. You could do less, you could do 1%, you can do 4%, whatever you want the growth rate. Konstantin, what's up? Good to see you. Konstantin has a good channel. Check out his channel. He did a live stream with me. But if you want a live DCF, you can donate $5 or more, and I'll do a DCF of whatever you want. Yeah, there was also Konstantin has a lot of insights into the market as well. But also with the with Silicon Valley, they were lending out to a lot of tech companies and startups. So there was a little concern with the money they were lending, because even though the companies they lend to weren't making money, they were losing money. As long as those companies can continue raising capital until they become profitable, like most companies, then it's fine. But they were having a hard time raising capital. Things were freezing up a little bit. Yeah, definitely. Another live stream. That would be good. And if anybody wants to do a live stream, even if you're don't have a channel, I'm happy to have you on a live stream. Even if you don't have anything to add, it's fine. You learn. And I'm sure you have a lot to add, most of you. So there was a lot of things that went, but we should work together. Let's try to find if there's any banks out there. If we look at their held to maturity assets above 10 years, like in Silicon Valley case, let me know. I can show you on Silicon Valley's 10K if you want to see, so you understand how to find it. But what assets they had on their balance sheet that were held to maturity above 10 years. Take that number over their deposits, customer deposits. That's all on the balance sheet. I'm just going off my memory, but I think it was something like 180, 101, 170, and then do the calculation. And if this number is really high, like Silicon Valley was really, really high, I think they were around 50%, then there's a chance that bank could default. Because I was looking at Signature Bank and First Republic. Signature was like 7%. So I was wondering, why did Signature default? And if they have such a low ratio, but from what I could find, and let me know in the comments, they have a lot of exposure to cryptocurrency, and that was a big reason they defaulted. I guess the because banks, the way banks make money is they take deposits from customers and they lend that money out to businesses or people or individuals. So if you put $10,000 into your Chase bank account, Chase pays you 1%, right? And then Chase turns around and takes that $10,000 and say there's your neighbor across the street wants a small business loan. So Chase gives your $10,000 to your neighbor, and they charge your neighbor $10,000 for that loan. So that's how banks make money, is on the interest rate spreads of these of the deposits. So in this case, they made a 7% return on the $10,000. So they make $700 on the money. They're paying you $100 each year to have that $10,000 in your Chase checking or savings account, and then they charge your neighbor $800. So their spread is $700. So $700 isn't a lot of money, but like, I think, I'm just going off memory, I think JP Morgan Chase has 400 trillion. Is it, maybe it's 4 trillion. 4 trillion in deposits. That's 4 billion. 40 billion. That's 400 billion. That's 4 trillion in deposits. So if their spread on that is 7%, you guys could correct me if I'm wrong, they make $280 billion on the spread. Is that clear? Does that make sense to you guys? Yeah, GPT, that might be a little too abstract of a question. Maybe in the future, but yeah, I could see even if you Google it. I mean, it's not like saying what's the market cap of the top 10 banks. Like, that's kind of a common thing. Like, you can just Google that and it'll come up. I guess if you can Google something, even if you have to search a little through Google, ChatGPT will have it. But you're not going to find something like that on a Google search. That's a bit abstract, but thanks for trying. That's a good idea. So let's do another. Yeah, just when you think you figured it out, because when the market crashed from COVID, not when the market crashed from COVID, in 2022, when the market declined a lot, because I was pretty bullish on tech, because growing up, when tech just started, like I was in school in the 90s and tech was just getting started, and then I barely used a computer much through college, a little bit, but not like it is now. It changed everybody, right? Technology changed the world, mostly for the better. Of course, there's negatives. So I'm really bullish tech, because I could see like tech being so prominent. And then when my Facebook stock went down and other stocks, I'm like, maybe I shouldn't be so bullish. Maybe I should pick something more stable. So I thought, banks. I'm going to go with banks. That's a stable investment. Banks have been around before, hundreds of years. They've been around so long, and that's how they make money, by receiving money. They receive cash and they turn that into more cash, and they're they're not backed by the government, but they're quasi backed by the government. A lot of them are too big to fail. So I'm like, I should put more money into banks. And now this happened. So I'm like, I don't even know what to put money into anymore. I think I'm gonna, obviously put in different things, but I think investing in things that like are important to live, like a company like Johnson & Johnson, a company that sells medicine, or a company like Kraft Heinz. They sell ketchup and different food products. Companies that have been around a long time, that sell things we all need. As much as we love technology, like we need certain things to live. We need food. We need water. What do we need? To bare necessities. Most of us need a place to live. Tyson or 3M? Yeah, those are pretty stable companies. I'd have to look at. Yeah, Kraft Heinz declining business. That's the thing. Like, not all businesses that sell food are the way to go. Like the same thing with tech. Health insurance. It's so obvious. Like, of course, we need certain things in life, but which companies are going to fulfill that? That's the hard part for us to kind of figure out. I don't know. I'm not sure, but I have to look more into Kraft Heinz. I'm pretty bullish on that company, but okay. If anybody wants to donate, you could donate $5 or more, and I'll do a live DCF. If you don't want to donate, we'll do a raffle now. Let's see if you got picked. 7, Clement. 5, Ishvan. Oh, wait, Ishvan, you said, right? 3. Lots of prime numbers. 3 prime numbers. CM101. Let's see. What other prime numbers are remaining? 2, 11, 13. So 2, 11, 13. Let's see if those come up. 6. So that's a product of 2 prime numbers. 5. Okay. Ishvan. You want to pick any ticker you want, and we'll do a DCF and maybe talk about the company. Hopefully you're still here. NTR, is that Nutrien? NTR? Well, you could donate, but right now, if there should be a button, is there a button to donate on a live stream? Or maybe I haven't done one of these in a long time. There's no button anymore. I hope there's a button to donate on this stream. You could be a member on Patreon. Okay, there is one. Good. You could Patreon, you can be a member. Also, YouTube, you can be a member. There's like a in YouTube, there's the 99-cent level, $4.99, or $99.99. If you do the $100 level, then I will do a video for you once a month. Every month, I'll do a video for you of your choice. So Ishvan didn't respond. Let's keep going. 13, another prime number, calcium. 6, Chris. Ian. 11, Sean. Prime number. 4, Matthew. Okay, calcium. Yeah, so what ticker should I do a video of, a DCF of? ICL. ICL. What's ICL? ICL Group. Tyson. Was anybody a fan of Mike Tyson? Swiss Re. The reinsurance is a good business. Does anybody understand like the business model for reinsurance? I did work in insurance for like 7 years, so I could explain it if. In the 80s and 90s, Tyson was amazing. So 57 billion. $56 billion. $55 billion. Okay. Now let's see. Evan, doing good. Good to hear from you. Of course, when you do a DCF, you're looking at the past, which is the past doesn't indicate what the future will be. It helps. Like if you were to lend money to a friend who never pays people back, who doesn't work, who has a lot of debt, his past paints a pretty bleak story about his future potential to pay you back. But if you lend money to a friend who always pays people back, has a good job, and no debt, his past is much better. So you're probably more likely to give to the friend who has a good job and pays people back. That it's not always the case, right? The past, the guy who always pays you back, you may have lent him a lot of money and then he loses his job or whatever, something happens. So we have to try to use past information to predict the future, which is not always accurate, but I think it definitely helps. It's all we have, right? Because we don't have crystal balls. So if we use the middle whack to be somewhat conservative. We're coming out with 74. Even though they had a pretty bad, they had negative free cash flow in the trailing 12 months and only 800 million. So that kind of drags down the numbers a lot. If it wasn't for these, their valuation would be much higher. So let's go with the higher whack to be a little more conservative. It's still undervalued. So it's a good base case, as you can see, the DCF model, but it doesn't tell you the whole story. If you are a really good analyst and you do a deep dive into an entire industry, you might be able to get more information. Like if you were really somehow on top of things and you predicted EV cars in the mid 90s or even early 2000s would be, if you read a lot of stories and you had a pretty good hunch EV cars, then you might have been able to invest in that sector well before everybody else did. Of course, it takes a lot of kind of guts to figure this stuff out and a lot of kind of expertise. But yeah, this is interesting. It seems pretty undervalued. So why doesn't more people buy the stock if a simple model says it's undervalued? Well, sometimes things undervalued end up going down. Sometimes things overvalued end up going up. A lot of it is market sentiment about psychology and way people think. It's a good starting point. I think it's a good starting point. And I think if you start doing a DCF, it is a good kind of base case, but it really forces you to learn about these companies. Like, I mean, of course, if you just go to a website and just plug in numbers, you're not going to learn anything. But if you're finding the numbers and you're trying to understand the numbers, or if you actually build a model and play around with it, you'll really start to understand these companies a lot better. But it's just simple logic, right? Like, it's the most simple DCF you could think of is like a bond. A bond pays a fixed principal and interest payment, generally monthly or quarterly, right? So you know what it's going to be. This is kind of like taking a bond, which is a predictable, or an annuity, which is predictable, and trying to apply that logic to it. Of course, stocks aren't predictable. Tyson is much more predictable than like a small cap company or a startup that doesn't have any positive cash flow. Because if Tyson just what is it, 2019? This is probably like 2019. This is 2020. If Tyson got back to these days where they were converting 6% of their revenue to free cash flow, the stock should be over $100. Let's see. Let's look at the chart. And it was over $100 not that long ago. Wait, what's going on? Wait, it was $100 in 2022. Oh, it cuts it off at 2001. I see. What, 1980. So from 1980, so for 18 years, it had a nice run up. And then the dot-com crash. So everything looks volatile in a short time frame, but when you when you bring it out 10, 20, 30 years, it kind of looks much smoother. Because it did get up to 20. And then it's been sitting around 20. And like everything, there's a huge bull run the past decade. But it probably should have never been this high. It probably belongs where it is now, possibly a little lower. Because everything was kind of overvalued for a while, it seemed. But we could see a few decades of flatness. Like we could see, like it was from 99. There's like 13 years of flatness. When it's 20 years, the chart, it looks flat. But if we made it, it looks a bit volatile, but it stayed in a pretty tight range. It never really broke through 30 until the 10-year bull run started. So it looks like around 2012, 2013. But look at that dividend payment. You get that nice dividend payment. So even if you were flat, you're probably still up. And when you're up a ton because you get the price appreciation, the asset goes up in value, plus you get your dividend payments, your coupon payments. So it's a safe stock to hold long term. Of course, if you buy at the wrong time, you might be sitting on it waiting for it to go back up. Well, look at that dividend. It was 4 cents. Imagine having a stock back in 2001 paying a 4-cent dividend because the stock was probably like $20. So they had to raise the dividend because stock price went up too. So your dividend went up 10x from 4 cents to 46 cents. But you have to hold. You can't be like, listen to people and sell the moment something happens. When you invest in these kind of like blue chip stable companies like this, you just got to hold. Eventually, you'll get compensated. So it's not a huge company, 20 billion. It's a mid cap, but it's a nice yield, 3.5%. Yeah, grocers definitely have a better time in recession, right? That's like a staple. Like you can't get around not eating, and you're much more likely to go to a grocery store or supermarket than out to eat when money's tight. So supermarkets are kind of like, so whether we're in a recession or not, there's demand for supermarkets. There's just more demand when a recession comes or money gets tight. Or they resort to stealing. How do you invest in stealing? Is there a company that tracks the stealing index? So yeah, no donation, unfortunately. I guess we'll just keep doing the free ones. I think the video games are recession proof. I wouldn't think video games are recession proof, but what do you guys think? I think like staple products are recession proof. Like things we need. I guess food comes to mind. Oil and certain commodities are kind of recession proof. We always need oil, regardless of what the climate is. Okay, first donation. Thank you. Very nice of you. U-Haul. The terminal value. Well, I'll show you the calculation. I'll put it in the chat. You could just Google it. It's just a calculation. It's not like U-Haul. U-Haul. And the WAC is very important too. That's part of the model. So all this stuff is so dependent on your result. If you pull a bad WAC, even if these websites say the WAC should be X, doesn't mean you have to use that. Maybe you have more knowledge on things. There's no future growth for U-Haul. Oh, here it is. Even if we didn't have information, we could still figure it out. Like I do videos with almost no information. I just have to figure it out myself. Well, that's past performance. So there's no future projections for this company. So we'll just have to figure it out ourselves. U-Haul is a pretty stable company. That's a product that's going to be always in demand or needed. I mean, it doesn't have to be U-Haul providing that service, but somebody needs to provide that service because people are always moving. But like the person said, is are video games recession proof? During COVID, they were, because people were stuck inside. When people are stuck in their house, certain things become more valuable. Bulldog Trading is a good man right here. Always supporting the channel. Very positive. He does live streams 24/7, so you can always go to his channel and it's always live. How's it going, buddy? Good to see you. So this is a little harder. So it would just take more guesswork on our part. Let's just do a flat, like 3% growth. Let's do a flat 3% growth. From their trailing 12-month revenue. BMO, Bank of Montreal, you're Canadian. Now we have to figure out what percent of their revenue they convert to free cash flow, because my model can't use their numbers because they're negative most years, right? So this is what I would do. And it's really guesswork. I mean, I can't predict the future like anyone can do. So I just have to kind of use information I have. What the fuck is it? Another big supporter, Victor. Right, Victor? Is that you? Thank you. Good to see you. Amazon's killing me. It's really killing me. What the fuck? I started selling on Amazon. I buy things and I sell it on eBay and Amazon. I just started it a few months ago because my friend does it and he got me into it. And I like learning new things. Yeah, Victor has a channel, so go to his channel. Please subscribe to his channel because he's trying to grow it. He's still at the early stages, so every sub counts. I can't think of what it was. Okay, so U-Haul, what industry are they in? Rental and leasing services. So the way I would kind of estimate their future free cash flows, I would look at everybody in their industry. They changed their columns, so I have to update this. Free cash flow F. So DF. Isn't that DF already? Oh, it is. Oh, shit. And change the columns. Okay. Now it's okay. So it's DN. I just gotta update Okay. So now I have the free cash flow for all the companies in their industry. I don't know how to do this. Yeah, ET. That was 3. Why didn't it say A? We look up. Oh, okay. I gotta put the ticker here. Okay. Hell. Oh my god. Okay. That's how you do it. Okay. Free cash flow. I gotta fix this column too. Okay, N4. GA. This is probably boring. I have to update these formulas. We have to do this once and then okay, okay. So what U-Haul, they convert on average for the past 4 years negative 50% of their revenue into free cash flow. Because so obviously we can't have a negative value for the company. It doesn't make sense. So we have to put a positive number in there so we get positive free cash flow at least at some point. It doesn't have to be positive every year, but at least at some point so we get a reasonable value. So the average company in their industry converts 25% of their revenue to free cash flow. It's mainly because this one company up here. Let's just go with United Rentals. Oh no, here it is, 12%. The median, let's go with the median. Because as you know, if you use averages, it might not help you. Because if one number is way out there, it drags up the average. It makes it look silly. So median sometimes makes more sense. So let's use the median, 12%. That's the median. The median percent of revenue the industry converts to free cash flow. There's a lot of NAs because those have negative free cash flow. But we'll use 12%. So this is the number we have to change to 12%. Okay. So here's the value. So if we have to make a lot of changes, right, to the model because the model doesn't work for this company. The model doesn't work for 90% of companies out there, maybe more. It works for companies like Microsoft, Google, big companies. But other companies, you have to do a lot of kind of manipulation. Doesn't mean it's a bad thing, just some companies just aren't predictable. So if we make these alterations, our valuation is 46, which is pretty close to where it's at. So it looks like it's slightly overvalued. That's assuming my estimates are kind of like where they're going to get to, which obviously might not happen. But the market is not based off of my model. It's not based off of the company's financials. It's based off of supply and demand of the market. It's what the market thinks. That's what really counts. So it looks like something I would probably stay away from, but that's just me. Yeah, Victor, thank you for donating. That's really nice. Very supportive. Amazon. AMZN. AM. I probably don't need to put it in there. Okay. Let's see. Yeah, I do like Amazon. Yeah, like Sean said, just because a company has negative free cash flow doesn't mean it's a bad thing. It could be a bad thing. It could be they were investing a lot in their through CapEx. And if that's the case, possibly it's going to lead to Khaled. That's who I was thinking about before. Khaled is Dutch. I knew there's another K person that's in a chats a lot. Khaled, you're from Netherlands, right? I thought Kyle was from Netherlands. Kyle, thank you. Very nice for you donate. Look how high the WACs are. They used to be so low. Now they're getting so high. Let's Khaled, thank you. Khaled is the biggest supporter of the channel by far, which I really appreciate. It's really very nice of you. So hopefully a company like Amazon, it's a little more predictable. Like U-Haul didn't even have future revenue estimates. See, 700 billion. That's crazy. 700 billion. I remember when I was a kid, when I got into stocks, like I was in high school, reading. It was kind of more like just looking at companies and looking at market caps, kind of what people do now. BTG. BTG. LC, thank you again. Okay, let's try to get this done. We have really awesome, like so appreciative, right? So generous. Is everybody from Netherlands so generous? I want to go to Netherlands because I know a few people now, like 4 people, maybe 3 people, who live in the Netherlands. Trillion market cap. Money Club. That's a hard one to do. I mean, I'll do a DCF on any company. It's just finance companies, they're really tricky. But I'm happy to try because actually they are frugal. That's interesting. This guy has a channel. What's his? He's from the Netherlands. He's a really good channel. I like his channel a lot. I can't think of the name of the channel. Okay. Looks like it missed a 0. $7. So the model says $7. So this is another, you have to intervene because obviously $7 for Amazon doesn't make sense. And the reason it's $7, this is why it's good to actually kind of like build the model so you can figure this stuff out. They had negative free cash flow the last 2 years. So let's just use these 2 years to calculate the C and D. Okay. So 11 is a high whack. I'm going to knock it down to 10, just see what we get. So I'm at 65 for Amazon. Unfortunately, I hold a lot of Amazon. But I think this is kind of like one of those things like, just because it says overvalued, undervalued today, you have to look towards the future. I think Amazon is just like a giant that just keeps growing. That's why I put money. That's like kind of part of my retirement, my Amazon stock. I hope it pays off. But yeah, the model's saying 65, unfortunately. BTG. When you do the models, and if you're on my Patreon channel, you get a free model like this. It's almost exactly like this, and then you can play around with it, the inputs and things like that, just like I'm doing. BTG. 30 people. Once I had like 50 people, 60 people, and it was a very exciting day. But it's very rare I get even 30. BTG. Khaled, thanks again. Very, did I put, yeah, I did do the, Netherlands. When's a good time to visit Netherlands? There's a stand-up comedian I really like in Netherlands, E2 Gold. I don't know if he does stand-up anymore, but Hans. It was Hans Hans Touwen. I think it's like Teeuw. Hans Touwen. Very funny. I quit my job. I couldn't do it anymore. I don't think it's healthy to work 10 hours a day and be depressed all the time or feeling like a slave. It's just hard to not like, because we need medical insurance and we need to pay rent. I'm fortunate that I saved up a lot of money. Well, I don't have to work, but it's not easy to use my savings. But I mean, I worked 20 plus years. I just want to get a break. My wife doesn't think that way, but she would like me to just work and be unhappy, but that's where we differ. Late spring or summer? Okay. When you say late spring, I assume you are referring to a spring in America, not your spring, right? The problem with Hans Touwen is I can't find many times he speaks English. Most of the time he's speaking Dutch, and I can't understand it. It's much better when he's speaking English. But he's really funny. He's out there. Okay, this is interesting. We're getting a lot of overvalued stocks. 273, which is not crazy overvalued. I mean, look at these margins, 33%. This really, if we strip out the latest year, maybe they were investing a lot, or maybe they had, let's strip out that latest year and just see what it is. Udar, what's up? Thanks for the nice comments. Everybody, thanks for commenting. Means a lot. We're still overvalued at 315. That's interesting. Marriage could be modern slavery. Yeah, this will be uploaded later. So it looks like it's slightly overvalued. Yeah, the WACs are really high these days. Okay, so Khaled always picks a really difficult company to value, but let's try it. And I've learned a lot from these Silicon Valley. I've learned a lot more about banks since they defaulted, because I did a lot of like research to understand why they defaulted. It's really interesting. I did a video. I thought it was a really good video, my Silicon Valley video, and it didn't even hit 1,000 views. And then I watched some other videos of other YouTubers have 1 million views, and I'm like, some of the stuff they say I don't even think is that accurate. I think it's so many views. I don't get it, but whatever. I mean, it's about personality. They have a really good personality, like really outgoing. Lending Club. with finance companies, the price to book is probably the best indicator of future the of evaluation. DCFs are a little harder. I go to the Netherlands. We'll live stream from the Netherlands, like I'm doing now. Synovis. Okay, thanks for stopping by. Yeah, most channels are pretty light on analysis and very surface level. But I could see, like, if somebody's coming home from work, I could see watching one of those channels because there's a lot of fluff there. It's kind of like you can like make dinner with that in the background. But with my channel, it's like you kind of have to really like watch it, and you can't just have background noise. So maybe people don't want to like really anything intense. They just want kind of a really basic. You deserve many more views. Thank you. I appreciate that. I think with these sort of videos, the platforms restrict small channels and push big channels. Yeah, I mean, the algorithm, when you release a video, this is interesting. Look at this, $21. See, if the DCF says, if the delta is so large, I mean, that's like a delta of 14. But I mean, it's like 7 to 21 is a big difference. Like 100 to 114 is not nearly as significant as 7 to 21. The delta of 14 is huge in this case. So I would just look at my inputs just to make sure nothing looks crazy. Like I have my WACC at 12. My conversion from revenue to free cash flow is 16%. Even though you have these crazy numbers, it smooths out with the negative. So that doesn't look too bad. So everything looks pretty normal. So I would look at the past. This is just kind of what I might do while I'm preparing for a video to try to understand it better. Because if I'm saying 21, right? And it's 7, it seems like a pretty wide spread. Like that's just crazy, right? But if you look in the beginning of 2022, it's cut off here, but that's 20. It was $21. So that would give me more confidence that it could get back there. I mean, if my model was like if I calculated 100 and the stock was trading at 40 and it never broke through 50 in like 15 years, that may not give me that much comfort it could ever get to my levels of 100. That just might mean it's a little out of whack, my model, because the inputs aren't so good. But this would give me comfort it could get back there since it was there before. Yeah, JXN, it's right here. I'm just trying to give you a deeper dive since you donated so much. Unless you're in a hurry, I could just jump to JXN now. So this is just something to think about. So it was at the peak 40. Sheesh. Okay, so it looks like they did a reverse stock split right here. See, I didn't even need that. Like, do you guys know how I knew it had to be a reverse stock split by looking at this? Because it was 126 at one point. If it was 126 here, I wouldn't have said a reverse stock split, but nobody IPOs at 126. Nobody starts that high. They start around between 10 and like 25, usually around like 17, 18. That's pretty common, around 20. Nobody IPOs for 130. So that's not possible. So it had to be a reverse stock split, a 5-for-1. They IPO'd for like 22. And the reverse stock split gives the appearance they IPO'd for 130, but they didn't. You have to divide all these numbers by 5 to figure out what they actually were trading at on these times. But yeah, but price to book is probably more relevant. So let's look at the price to book for the industry, everybody. I don't even see LC on this list. Okay, let's see LC. But this is the type of company I would probably need to like look at their actual 10K to feel more comfortable giving. Okay. I wonder why they, for some reason it didn't really show up on their website. I wonder why. The average price to book is 2.1 in the industry. They have a really good price to book. It went from 3 down to 0.6. So either it's really, really undervalued according to the price to book, or they have a really, really weak lending platform, and a lot of people go to default. So 0.6. These other companies most have a 1 over 1. It's not too common under 1. So they have over $1 billion of equity on a balance sheet, and their market cap is like 700 million. So why do they have so much equity? relative to their market cap. They don't have a lot of goodwill. I mean, as long as the people they loan to pay them back, this is a really good investment. Or as long as like 90% or 80%, whatever obviously you can't get 100% payback, but I mean, but that's built in to every company. You can see it right here, 6.1 billion of loans, and the loss projection allowance for losses they have to put down on the balance sheet is about 5%. So 327 million of losses they're projecting. So if they're in that range, it looks pretty solid. JXN. I'm just learning like you guys, so like a lot of stuff I don't know, so I'm kind of like learning as I go as well. So feel free to correct me or throw in your 2 cents, because it's not like a math equation. There's no fixed answer. It's kind of like a lot of judgment involved in what we think or what you think. 30.8. I can't remember. Was it JXL? Was that who we're doing? Oh, JXN. I mean, Lending Club's a big name. So, I mean, banks and financial institutions tend to be pretty stable investments, as long as you don't get out of hand. Like you don't lend out to too many people who can't pay you back, like they did in a subprime mortgage crisis. That's what led to the Great Recession. You don't want to lend to people who don't give you a down payment or who have bad credit history. And you don't want to take the money and invest in like other risky assets or get too leveraged. As long as you run your business somewhat intelligently, you should be fine. But of course, people get out of hand. They make a lot of mistakes, which we all know. Jackson Financial, not too familiar with this company. Lots of free cash flow. But sometimes you find these golden nuggets and the stock just sits there for years and years and years. So it's hard to just understand why, this is saying $600. So obviously the DCF might not be the best tool for. Let's look at. Thank you, Aldridge. That's really nice. I appreciate it. Let me know if you want to do another video, or we could talk more about Zim, because you can never learn too much about a company. So they have it at 123, but they tend to be on the high side, so I don't always listen to them. There's 5 analysts pricing the stock at 43. It's trading at 35. So when you see an analyst price target, they're not using usually a DCF. They're saying what they think the stock price will be, which is different than what I'm doing. I'm saying what the company's worth. So what something's worth and what someone's willing to pay are two different things. They might converge, but they might not. So let's see. Why is such a big difference? See, it's hard to. Let's just go with the 36% because it's hard to convert more than 100% of your revenue to cash flow. That might just be like a one-off thing. Like it can happen 1 year. So let's just go with the lower one, 36%. So it's still extremely undervalued. Life insurance, that's right. Life insurance is it's a different animal. Annuities for retail investors, fixed income products for institutional investors, direct subsidiaries of specialized management, retail brokerage, subsidiary of the British Insurer. Okay, subsidiary of Prudential. So it pretty much is backstopped by Prudential, which is good. They acquired them for $600 million. The company is unrelated to the American insurance conglomerate Prudential Financial. Finance 61. Yeah, this is one of those things you might have to just dig into but email me, Khaled, and I'll try to do a full video on this company or whatever since you donated so much. Hopefully I give a little more detail. Because when I do my DCF, a lot of companies, I can just do my basic DCF with a little extra info. But when it comes to a bank or insurance company, I have to diverge a little bit so it makes sense. Because obviously in this case, the DCF might not be the Petrobras. Companies like manufacturing companies that much more plain vanilla, it's a lot easier to use DCF and explain it that way. So Petrobras. Petrobras is so severely undervalued. I mean, there's pretty much one reason why they're so severely undervalued. Does anybody know the one reason? Let me know if anybody knows. There's one reason that really differentiates them from most oil and gas companies. Yeah, where they're located pretty much is the reason they're undervalued, because people are not paying as much for them. I mean, it's like if your home was in Beverly Hills, California, and it was $3 million for your home, and you move that same exact house, exactly identical house, and you put it in Tallahassee, Florida, and now it's $300,000. It's the same exact asset, right? It's the same exact house. It's just that you're in a different place. So if you have a company in like America, it tends to be a little more overvalued. But if you have a company in Brazil, it's undervalued. In Germany or London, it's probably not going to be too undervalued. Those are pretty stable economies. You do get a really fat dividend, which is nice. They reais. That's how you pronounce reais, US dollars. 0.19. Even though I always do a lot of research on pronouncing names correctly in my videos. I try to pronounce it the way they do in that country. So even though it looks like reais, it's actually pronounced reais. Reais. Yeah, a lot of risk when you invest in a developing country like Brazil. A lot of political risk, currency, a lot of things like that. Like that's um oh okay, reais anyways. It's not too important. Okay. 500 billion. Big number. Since we're looking to take out the trades in the US, we have to convert everything to US dollars. It's pretty much the same. Okay. Hymns. Hymns. I started using hymns for my hair. Not working. It's been like 9 months. I should do another video on PBR. It got a lot of views. I mean, their ratios are unreal. Look how much cash. 40 billion. That's reais. I should set this up to convert it quicker. I will for next time. I mean, oil prices, it does definitely affect the company's returns. I mean, oil prices were crazy high for a while last year. Yeah. And look at this. It's like even it's a high whack. Even with a high whack, it's still $33 a share. I mean, it's just so undervalued. Like, and it was 71 in 08. The last time it was in the 30s was 2011. But they're generating so much cash flow. I mean, look at this dividend. They pay almost. They give it all back. They have so much cash flow. So if you just buy it, if you bought it 6 months ago or 9 months ago, you almost got most of your money back. Even if the stock went to zero after a year, you would have got your investment back. Like, it's just ridiculous, the dividend. But don't tell anybody. It'll be our secret. But the problem is, how long? And it's frustrating because when you do a lot of research and identify these stocks, Hims is a fun company. That's why I kind of like to stick to American companies because a little less volatility and as much people complain, there's not too much problems with the government interfering with businesses. It's pretty safe. I mean, I guess every country has their problems, and every country you can complain about, but we're the best of the worst, I guess you can say. Okay, here's a good one that all hipsters need to talk about. A Palantir. Yes, Palantir. Thank you again. It's too generous. I'm hoping I don't have to work. I mean, I don't need millions. I just need a few thousand a month to cover my expenses. I don't. That's what I'm hoping to do. Although there is a company I was doing their books for, and I'm going to be going there a couple days a week because I need to get out of the house and do something. But I don't want to get a full-time job. I don't definitely don't want a full-time job. But I'm happy to go somewhere a couple days a week, and I like the people there. Is important. Okay, hymns. I do like hymns. I like what they do. I like their platform, and I get it. It makes sense to me. Like Palantir, I did invest in Palantir and I lost money. I'm glad I sold because I would have lost more. But it's kind of like you don't totally get what they do. Like I kind of understand what they do, but I mean, it's not very. You can't really explain it to like your grandmother kind of company. I guess that's the way to think about investing. Can you explain it to your grandmother where she understands what you mean, or your mother, or whatever you want to call? If you can't, I would just not invest. Seriously, I'm thinking about jumping into Zim. Yeah, I mean it's come down a lot. So if a stock is lower, a lot lower than it was, it's a better time to invest now than before. And when a stock goes up, it's a worse time. So now you have to decide, is it the right time, or should I wait, or the wrong time, or a lot of things have to go into it. But all I know for a fact is it's better now to invest in Zim than it was a few months ago. That doesn't mean you still can't lose money, but it's definitely better than it was because the stock price has come down. So obviously we can't. They have negative free cash flow. So let's do a quick household and personal products. Um, so there might be a better way to figure this out. I mean, I could think of a lot of ways 100 ways to do everything. Any particular thing you can think of different ways to do it. But is this the right way to figure out their free cash flow margin? Maybe. Why is it? I fixed the formulas. I see. Okay. Okay. You could do better with day trading if you. It's more difficult, but I mean, if you do due diligence, like that's what Warren Buffett did when he first started. He focused on those small cap stocks and he killed it because he had a lot of insight. Let's change this to 11%. Oh wow, look at that. That's really interesting. So we're assuming they convert 11% of their revenue to free cash flow, which is the industry average. That's where I get 11% from. Of the companies that do generate positive free cash flow, that's their average. So it's trading almost exactly at intrinsic value. So that's kind of interesting. And IPO'd at $10 because it was a SPAC, so it's pretty much trading at IPO. Yeah, I mean that's a big concern, right? If Zim cuts their dividend, which they might, but I mean it seems to be providing a pretty good buffer. I just want to see the chart for HIMS. Yeah, like most SPACs, there's a really fast run up, and then it comes crashing down. Look, it got below. Looks like it got close to $3, and now it's coming back up. The problem is they don't make money, which is generating cash is not the most important thing in the early years. Sometimes growing revenue is considered as important, which they're doing. So as long as they get to profitability at some point, it's fine. I think they will, but they haven't got there yet. That's a lot of cash. I mean, that's a lot of revenue, right? $500 million. Imagine having a business with $500 million of revenue. So at what point do they become profitable? $1 billion? I don't know. But so that's kind of what you have to ask yourself if you would invest in this stock. I mean, I like it. I like the company, but I think I like the stock too. But it's a little these SPACs, a little questionable. 13.5. This is a crazy company. MPW is a REIT that looks fine. Hey Ed, A to Z, what's up? But the market dislikes its debt load. Well, REITs, you kind of have to have a lot of debt to be a REIT because you have to distribute at least 90% of your income, right, to shareholders. So there's not much left over to grow. So they do need debt to grow. I mean, they might have too much debt. That's the problem. Palantir. That's still trading below IPO. I've seen an interview with Andrew Dudum where he asked about their headquarters location. The answer was they run a business without one and they had to keep it slim. They're generating positive cash flow. That's a good sign. The thing with tech companies, should be easier to become profitable. HIMS wasn't there yet, but they may be spending a lot on marketing. Yeah, I'm holding Accelera, and so we kind of have to strip out these negative years because we can't get much of a value. Let's use this 21%. Did I mess something up? So they have 1.9 billion of revenue. Yeah, it doesn't look good, at least for the DCF. Because when we're looking at, was it HIMS that had, oh no, Petrobras. Like they had like a lot more revenue than they're worth. Like they had like 100 billion of revenue. No, they had like 60 billion of revenue, and their market cap was like half that or something. And this company revenue is under 2 billion. So their price of sales is about 8. So it seems like they're overvalued still. But there was companies called Tesla and Amazon that had PE ratios of 1,000, and people were gobbling up the stock like crazy. And then now the PE is normal, and everybody's selling off the stock. But let's lower the WACC. Let's lower it to like 8. It's still at 6. Still overvalued. You kind of have to buy the stock. You kind of have to do the opposite, which is a little confusing. It's best to buy a company stock when they're overvalued. I'm talking about before they become a stable company. Like Google is a stable company at this point. Same thing with Apple and Microsoft. They've been around a long time. But when a company is growing and scaling, you have to buy it when it's overvalued. And then once they get to the point of like what they should be worth, then you have to sell it off, or before that point, because then that's when a market jumps in, when the PE is like 15. When the PE is 1,000, but the thing is, if you start buying a stock when it's overvalued, a lot of times people hold on to it too long before they sell it off. And then they hold, like, Like for instance, if you put 10,000 into a stock, and then it say it tripled in 2 years to 30,000, and you're considering selling, but you still see the potential, and then it goes to like 24,000. You don't sell because you're like, it just was 30,000 6 months ago. So you kind of like, I'm not going to sell it now. I could have sold 30,000. Then it goes to 22,000, then 18,000, then it's 6,000, and then you're lost from your initial investment. So it's like people just generally don't sell at the right time or even buy at the right time. That's the hard part. The PEG ratio. So the PEG ratio is the PE. So the PEG ratio is the price earnings growth. So PE, which is a known number, right? We know that because that's historical. And then the EPS growth, that's generally what analysts project the growth to be. So there are assumptions that the growth rate may be too aggressive or maybe not. So that's an interesting number to look at because the PE looks to past, and the idea of the PE growth is looking at the future if they grow into that. And what's their PEG ratio? So it's 0.7. So I guess the lower the better for this. Lower than 1. And now they're lower than 1. Look how they were at 4. Who's a similar company to Palantir? I want to see another company's PEG ratio. A software infrastructure company. Snowflake. Yeah, donate if you want a DCF. Their PEG much higher, 4, 6.5. Look at that forward PE over 1,000. You can't look at trailing because they have negative earnings. 45 billion. It's a big market cap. Yeah, I remember Snowflake. Look how high it was, almost 400. And it was even 400 right at IPO, like right after they IPO'd, like within 2 months. Then it dropped in half. Then it doubled again. Wow, imagine shorting it around here. That would have been brilliant. And if you ever read like go to YouTube videos and read comments, like it when it was like 200, people like, you have to be an idiot not to buy the stock. It can never go below 100. Well, it didn't actually go below 100, but it got pretty close. 120. Facebook got below 100. That was scary. Appcelera. I should do a video on Appcelera. I did Nokia today, a video on Nokia. Appcelera. It was 14 a few months ago. So volatile. Look at the revenue growth, 11 million to half a billion. Okay, Khaled, see ya. Thanks for joining. Yeah, lots of cash. Why do they have so much cash? Did they do an equity raise or? Lots of free cash flow. Look at that. Even with small operating income, they still generate cash flow. Because with these types of companies, it's just really manpower. What's in the people's heads trying to create a new medicine and doing research, trying to come up with what's my so Appcelera. They don't have to build like these factories, and they don't need like really expensive machinery to do what they do. It's just really about coming up with these new because they're really unique. They're specialized. They don't actually come up with the medicine. They just come up with the antibodies, right? And then they hand that over to Merck or Pfizer and let them finish off. Like they do the hard part of the research. And then they hand it off to a larger company to kind of, do the trials. Like you have to do a lot of testing, there's a lot of phases to get FDA approval. And then they let them do clinical trials, to make sure it works and what type of how much of the medicine should be used, and then they get their patent and then they market a drug and manufacture it. But Appcelera doesn't just handles the R&D part, figuring out the hard part. What do you do with a company like 3M that has so many lawsuits? Yeah, I mean lawsuits, every company has a lot of lawsuits, right? It depends how significant. I'd have to look into it a little more to see how relevant a lawsuit is, because a lawsuit, if it affects your company where it's 10% of your cash is gone, but what's it called? Philip Morris, they're constantly dealing with lawsuits. They're paying billions and billions of dollars out, and they're still so profitable. They have so much cash. So, yeah. But lawsuits can be a great time to buy, because if it's people are selling off thinking the company may go bankrupt. I think Warren Buffett said that, like, about lawsuits. So peaked at 235. But they make some, their products are so important. 3M. They make products like staples people really need. So there's always going to be demand for that. Yeah, Peter Thiel. That's why I bought Palantir to start, because of him. Okay. And any other donations before I log off? $20 billion. That's a big lawsuit. 20 billion with a 55 billion market cap. Yeah, a lawsuit like that can ruin a company, but when you get sued for a certain amount of money, you're probably going to pay a lot less. People usually aim for the fences, and it's kind of like a negotiation. But yeah, but that could be concerning. That could really keep the stock low for a long time. Okay, so if there's no other, nobody else wants a DCF. I see all over Facebook Army lawsuits about. Yeah, that's great. Yeah, it's nuts. So Nokia is coming out tomorrow. I guess I'll work on Intel. Yeah, Intel my next video. Yeah. So thanks for joining. Good to be back. And I'll probably do every Saturday a live stream, possibly during the week too, if I have time. Okay. I'll see everybody later. Thanks.